Great stuff.
Bye-bye.
Bruce Fraser, R.D. Wickoff, welcome back to F.A.C E. How are you, Bruce?
Dale, can you hear me?
I can hear you. I'm glad to hear a calm voice. You always have one. So, Bruce, your demeanor doesn't change, peace or wartime. So, Fed tightening or Fed easing. What's on your radar in these unprecedented times? I've never traded a market like this, Bruce. How about you?
Well, 40 years of this, and they all seem different to me. So, yeah. So anyway, let me.
I mean, I don't even think that this is the 70s on steroids. If you're, want to go back then, and that and everything was so much different then. This is, something that, well, I mean, a superpower. So there've been conflicts in the world over our career, Bruce, but not with potentially a superpower like this with Russia. So,
oh no, it's tragic. War is always tragic, and then of course I was around in the 70s and experienced all that as a youth, but I was in my career, and so it was a very interesting time, and so there were a lot of similarities. A lot of things were similar, and so here, our little guy here is this is a cartoon from the 1907 crash.
Oh wow!
I believe it was then, and you can see Mr. Wall Street here is got an ice block on his head, and his feet are in some hot Epsom salts, and he's got elixirs and so on, and so you can see
they had good elixirs back then.
Yeah, they were better then. Yeah, they were better.
And is his face a pig? Like bulls and bears make money and pigs don't? He almost
I think like a pig. I think Mr. Wall Street he might wish at that time that he was one. Yeah. But here, this is a very old cartoon, and the bulls are running this investor up to the peak and over the top. And so that's kind of what I want to talk about today is this whole concept of Wyckoff distribution. And I have some kind of an odd collection of slides that might also help us to, get to the bottom of this whole inflation thing, and not to the bottom of it, but maybe understand it a little better. And with your permission, I'd like to do that. And,
you're the guest, so you're the boss.
Well, I know, but it's always good to be here. Yeah, I love being here with you.
Well, and thank you, Bruce.
And so here is this just basic price cycle. We're all familiar with it, and the whole notion of it was, and Mr. Wyckoff wrote about this and talked about this back 100 years ago, and this was the idea of the cycles of accumulation, distribution, and over again. What I'd like to make a point of today, because we're all familiar with this, is that the reason that we get markups, is what we call them, is because we have a process that occurs called accumulation that creates the conditions where a markup can occur. And then after that, there's a period of distribution that creates the conditions for markdown. And so this is something that we work on the price charts and on the point and figure charts. I'm actually going to do a lot of point and figure charts today, given the time that we have. And so this is a fuzzy old chart, and I actually found a better one. I'm going to upgrade it of this that Roman did. And Roman is one of my teaching partners at Golden Gate. I don't teach anymore at Golden Gate, but I do write a blog at stockcharts.com, which is available to everyone. So I'll show you how to get there. Well, here it's, let's go back.
So the biggest mistake, don't you think, is that when you're turning a battleship around, like this recent top in the market may have started, I mean, there were undercurrents and stocks already breaking down before the averages rolled over. And that distribution phase is the stronger the bull market, the longer it would take to distribute and turn around the battleship, just like accumulation? You have to be
Absolutely. I think
patient.
that's an excellent way to describe it. It's a good analogy. And so, like, the bigger the accumulation, the potential for a much bigger markup, bigger the distribution, the much bigger the markdown can be. And also keep in mind that distributions can occur much quicker than accumulations. And the reason for that is because there's a tremendous amount of volatility that occurs in a district. And volatility is the condition here that causes, which is evidence, let's say, of stock changing hands. Because there's a phenomenon occurring in distribution, and that is that stocks changing hands from strong holders to weak holders. And the reason you can get marked down is because the stock is in weak hands. And so who are strong hands? Strong hands are what we call, it's really, we call it the composite operator, which are the super large, very well informed, very shrewd investors that are out there. Most of them are institutional types. It can be hedge funds, it can be institutions, they can be individuals. It's their conduct that counts more than their than how we would characterize them. Not all institutions are composite operators. And so composite operators are thus because of their skill sets. And so they build very large positions and they hold them for the duration. So here are schematics. We use schematics for a lot of things in Wyckoff, and uptrends, downtrends, accumulation, distribution. We actually did an accumulation kind of workshop here a long time ago, over a year ago. So I thought it might be appropriate to do some distribution.
I have one question, Bruce, if I could ask you about the distribution phase. You know, for months we had vicious sector rotation, you know, the move from one sector to another that kept the market alive, that type of rotation. So could that be part of a distribution phase that, you know, if we ever get this again, that when we see this type of rotation supporting the market, that's also part of a distribution phase?
So, absolutely. And the thing that's happening in distribution is that these CO types are disgorging their large holdings, and they have to do it carefully, stealthily. And so they're very shrewd about how they do it, and they do it into strong markets, into momentum. And so they will rotate into other areas of the market. Part of what that does is it helps to prop up the indexes. And so, you know, they say that a bear market is like a thief in the night. You know, they come when you don't expect them, which is what distribution is. And so you pointed out that you can have stocks that are under distribution for a long period of time, long before it shows up in the indexes. And so what's happening is that stock is being distributed, and then it's being redeployed, some of it into areas of the market where the market can then be held up, or it tends to hold up. And there's an old saying, an old Wall Street adage, that beware when the generals march alone.
Yeah.
And what that meant was that the generals in the old days were General Motors, General Electric, General Reed, and not just those, IBM. Yes, and what they did is they would drive money into the most conservative areas of the market, and that would tend to give those stocks lift, keep the broad indexes alive, while they were secretly, quietly, not secretly, but quietly removing money from the areas that they were no longer campaigning. And so here I just
giving tips to congressmen and Fed officials.
Yeah, well, yes, we know. We know that happens. So here, I put references to some of the blogs. You can go see these blogs. Like I said, they're absolutely free, not behind a paywall, at stockcharts.com. And you'll see that there's a zillion of them that I've written on these different Wyckoff topics. Now here you can see, here's the NASDAQ 100 on the left, the S&P on the right, and you can see here that the distribution characteristics are being, we use these terms, these abbreviations to define these different places in the market. And so what these are, though, is that these are phases of distribution. And one of the characteristics of distribution is that it becomes more volatile as you go through distribution, because stock is getting into weaker and weaker hands, and it's not being supported well by the large interests. Part of what creates accumulation is a large interests are supporting those stocks at value levels. And so that tends to take the volatility out of them. And so at tops, you get the opposite condition. And so volatility increases. That's the reason why point figure is a function of volatility, and that distributional point figures can form very quickly. Now here's the S&P 500. Now notice the difference. There's a little subtle difference here I want to point out. Both of them have very similar characteristics. So here's these classic distribution structures. People call them, have been calling this head and shoulders. It's an excellent description. We tend to look at it a little differently because we break these segments down, these areas, into phases. And you can see here that something very important in our work is to see a sign of weakness, which is an important break. Look at the volatility here. It's a massive change in character in the way that the NASDAQ is acting. This was an interesting change of character here, and was actually of greater degree, or let's call it greater intensity, than even this one. And look at the volatility expand with higher volume. And so volume is coming in on declines. That's a sign of stock being sold in large quantities. What tends to happen in bull markets and also in accumulations is volume tends to dry up as stocks are pulling back, and that shows absorption. So here, look at this. The S&P, which is where the more blue, call them the more blue chip names are. Think of that comment about the generals marching. This had an upthrusting action after the buying climax, which was this acceleration into the top of the trend channel. Here you had this acceleration early November, did not get an upthrust, but you got a test of the buying climax peak. Here you got an upthrust, slight sign, very subtle sign, and we're always looking for those in Wyckoff, of more strength in the S&P than in the NASDAQ 100. NASDAQ 100 had always been the stronger index in this bull market.
Amazon didn't make a high, had not made a new high, didn't even make a new high. I think it peaked in November.
There you go.
Everything else was marching.
Very good point. And so
can I ask one question of
course.
We have an attendee who's most likely a Forex trader. And can these patterns be applied to other asset classes, these principles?
Oh, I think all asset classes that trade in an auction style. Okay. Because one thing I've noticed is Bitcoin. Bitcoin really seems to follow these principles. Bitcoin works really well on a point and figure basis. And definitely commodities. I have a number of commodities that I'll probably run out of time, but I would show them to you. But here are these two schematics I showed earlier. Note how the schematic number 2 is very close to what happened in the NASDAQ 100. Schematic number 1 with this upthrusting action is very similar to what happened in the S&P. Now, what's unusual is both of these happened at the same time in 2 different indexes. We don't always get that characteristic, and so it's interesting to compare and contrast. So now the other thing that's happened is that we've broken the strides of these uptrending channels. And so that's very, very important also. And note the rally in the NASDAQ 100 here could not, this is called the last point of supply. This rally could not get back to the lower trend line. where on the S&P it did. So, and could not rally to old resistance, new support, and where the S&P did. And so you can see here that there are definitely commonalities. The other thing I was asking, I wrote this in a blog and did it in some of my videos, which are also on stock charts, is that I was looking for a rally off this low because I had some point and figures hit. And this rally, I was saying the quality of this rally is going to be really important. So far, the quality is not great. Now, that doesn't mean that we notice how this rally is failed more quickly than this rally. We're always looking for these compare and contrast relationships.
Smaller magnitude. Let me ask you this, it would be a guess for you because we're not there yet. I look at things like threes, and you had your first low at 42 and then 41.20. If we flush to one more low, does that build the case for accumulation if you get a reversal after we take out the low at 41.20 that we put in a week or so ago on the invasion? Or would we have to go longer period of time since we just came out of distribution and we're still in the markdown phase?
Well, yes, I'm always of the mind that we'll always build a cause. Now, but before we get a move, this was a cause. See this right here? That was a cause, and that produced this rally. Right. And we get those. I have a couple of examples if we can get to them, but here, this is a selling climax of sorts below support. Right. And I would automatically, because I would automatically draw a trend line across that low. And so that becomes an important support area. And notice that's where we are now. Right. So this low from yesterday is really testing the 41.25 area, the 41.20 area that you're talking about.
Yeah.
And so this could be, Dale, some kind of an accumulation structure that's starting to develop. I'm very cognizant of that. But the other thing that I would be doing is I would be starting to think about point and figure analysis for the potential for how much could this go up. And then the other thing that I'm asking is there the cause in my point and figure counting, and it's called horizontal point and figure counting. I've written a lot about it. Have we fulfilled those counts yet? And so that's also important. And so you can see here, and I'll just leave this for everybody to look at, but you can see the characteristics. Now, some people might say that this is the buying climax over here on these, and I would not argue with that because they both have really similar purposes, preliminary supply and a buying climax. But so anyway, I make that point. But let's move on because now let's get in a little bit into point and figure. And so this is the triple Qs as a surrogate for the NASDAQ 100. And so you can see here are these little accumulation structures that we were just talking about, Dale. And so one of those could very well be forming in here. And this was in late 2020. And look at how this is just what I call a swing trading accumulation structure. And a 5-point scale, these are each 5 points. And then one box reversal method, which is a shorter term swing trading kind of a count method. So this count beautifully went up into the range of this high, which also was the top of the trend channel. Well, it actually set the trend channel because this is what we call supply line. Then we had a second one that counted up to here. Well, interestingly, this count, this reaccumulation count, reconfirmed this one, which is really interesting because often when you get reconfirming counts and you don't have higher counts at higher levels, that tells you that you're exhausting the move of the channel. We have a throw over at the end, overbought, fulfilled 2-point figure counts. What happens next? Yeah. So here's what happened next. And so we came back into the channel Often when we reverse down into the channel, we get a lot of volatility. And this is the distribution structure that we talked about on the vertical chart. So
I like how you did that. That was pretty slick.
well, it's really just because I'm lazy and I don't want to mark up a new chart.
Yeah, you had an insert ready. That was pretty good. All right, go ahead.
So, but look here. Now we ask the question: have we fulfilled a count? Now this is on the Qs, which would be similar to the Nasdaq 100. But this little swing trading count up here counted down to this area, and look, we're stopping here.
Yeah.
Yeah. So this is really fascinating. My concern now, again, I am now definitely on the alert for the evidence that says we're completing some kind of a structure, either for a redistribution, or we may be creating some kind of a structure for a possible swing trading accumulation. And so it's a little too early to tell. There's some things we need to see in the charts to help us determine that. And also the other thing I would say as a caveat is that this area here could very well be a larger distribution count. And so we need to just be super aware that we have now broken our stride. The one thing I would say, and I heard some great comments about the Fed as we were just getting ready to start, and that is that Fed hasn't started to raise rates yet. And it doesn't appear that they've started to expand their balance sheet. So I'm not a fundamentalist by any means. I'm not a Fed watcher, but I have studied the past histories of rate increases in the market, and usually it takes a few rate increases to stop a bull market. And so
I'm just hear 2 steps and a stumble.
Yeah, that's a great old term, and also
of course it's old.
Yeah, well,
it came from
yeah, the last I think it was in the 05-06 period. I think it took like 6 rate increase events to really stop the run, and I think it was then, and prior ones similar, and so it can take a while, and rates haven't even officially started going up yet.
So we could have another run in the market, even though the Fed is hiking for a while, that the market adjusts to it and we get a run. I mean, there are a lot of areas in the market that are great inflation hedges.
Exactly. And so it's exactly right. And also, until they get interest rates up to the level of inflation, which is what Paul Volcker did,
they won't do that. Do you?
I don't think they can ever do it. Yeah, I don't think
that's what
possible. I mean. Yeah. So I think we have about 5 minutes left.
Yeah.
Let me cherry pick this is just a swing trading chart. I showed to you as a way to plot and chart intraday point and figure. And you can see here how I tend to do that. This is the early 2021 February to March accumulation structure. Look at it, counted right up to the highs, and the bigger count, the larger count. So it's just like these things are great. Now here's the Dow monthly. So this goes back to 2011. Look at this beautiful trend channel that we've been in the Dow. I love to look at the Dow, even though it's really old school. But so throw over here, stops the advance, becomes range bound mostly. And then look what happened when it had a final touch and went into the channel, became super volatile in 2020, became super volatile in late 2018. And then here we have this really epic run from the COVID low. Epic above the channel. But look at how it rode on the top of the channel, and now we're back into it. And so I'm a perpetual bull. I want to see it run back up and be able to rally to or back through the top of this overhanging supply line. But volatility does happen once you get back into the channel. So we have to be really aware of that. And this looks an awful lot like a potential distribution too. So we just got to be super careful. And
I want to ask
just
you, be
yeah.
careful is a good thing to do all the time in the markets. I just
Well
want to
said.
ask you, Bruce, you know, we've had parabolic moves in a lot of commodity markets in the markup phase still.
Sure.
Some haven't topped. We may have gotten the top in copper this week. So with this type of markup phase that I don't think have seen in a long time, would
Yeah.
you expect a very long distribution phase in commodities for them to even correct?
Yes. And also one thing that I've done here recently, I just want to show you, this is a chart I made back in January of 2021 and had been showing it in my videos and in our Wyckoff classes. And this is the count lines at 35, counts up 85, 112. Not uncommon to throw over the top of a count, especially if it's in a super bull run. And you can see this climactic surge here, and that's occurred, which is this is through March 4th. And so this could be climactic, and also it's into a count objective. That why Wyckofians love that. Now I would not step in the way of this. I would wait for a cause. Look at this. Crude.
Wait for a failing rally, a break, and then a failing rally.
Crude is an amazing commodity for point and figure analysis, and I've gone back and studied crude cycle after cycle, and the counts are just remarkably good. This gives me some hope, actually, from a geopolitical point of view, that maybe we've had a climactic surge. Maybe we can at least stop and go into a range-bound condition. Maybe it's reaccumulation, maybe it's not. I suspect we would be in this for a long time. And then before we can have another big move, I would not be trading on this yet. I think it's too early. But let me just show you one other example, and there's just a bunch of them. Let's not do nat gas, but look at this count goes back to 2009. I mean, this is crazy stuff. And these are just really for illustration, because I want to make the point that look at copper here, around 504, I think was the last I saw it, and it's sort of calmed down some. But look at the structure. We talked about big accumulations, big causes. Well, if this is accumulation and it's trying to get up and out of the structure, this all means that copper is tightly held in short supply, and that it could be very difficult to get for manufacturing appropriate.
So point figure targets are $24 up in that range.
If this thing bears out, you know, I'm not saying it will. And so I'm just showing this and saying, beware, because look how long this has been trading in this tight little trading range. And so it's pretty nutty, but I would just be super cautious about breaking out of, like here, maybe it's not going to break out. Maybe it's just going to hang here for a long time and just trade in this area. I would love that. I don't want to see these commodities take off. Nobody ever calls me and asks me, but you know, here's silver.
So I mean, okay,
just
go ahead. So silver,
it's just all it is, and we'll button it up here.
No,
but
good.
This is 2020, the COVID low, back to 2014 in silver. And look at these counts, and silver came up and out. It's been consolidating, and these are just counts. I mean, it's like I'm not predicting anything. I'm just counting these structures, and I let the market tell me where to go. I don't, you know, I figured out that I'm just not very smart, you know, and that it's better for me to let the market, the tape tell me where it wants to go, and I just go. So here's the silver miners. And so these counts are, you know, really substantial. And look at this. This is a structure that goes all the way back to 2012. And so these are, they're large, and I would just be very respectful as a risk manager of this phenomenon. And I've just got bunches of these commodity markets that have similar looks to this. Coffee market, cotton, cotton's already running. And wheat. On and on and on. And I guess maybe the last one I'll leave you with here is here's gold. And so you can see, I actually wrote a blog. I write blogs on this. And I wrote a blog at this low in August of 18. So just go to my blog site to read it. And you can also get this chart. But look at this. So this is what we've been doing since mid 2020. We've been building what looks like another cause. It's now over a year and a half in duration on top of a bigger one here. And so there's just cause on top of cause in the gold market. And now look where it is.
What's your
trying
point and figure target on gold?
Gosh, it's like you're just ahead of me. And so now I haven't counted this area yet for publication. So, but now that it's up against resistance, the count very well could be near completion. Might pause here for a while, but here is the structure. Now I'm just using GLD for this, not gold, which is this continuous contract monthly up top. GLD, I'm just counting this area here. And these are counts that I get on GLD. 3, and this is where we are right now, or we were as of, I guess, yesterday.
Bruce, great presentation.
It's so great to be with you. And thank you so much for inviting me.
It's like going back in a time machine to talk to a guy like you, and your demeanor's great. And, I'm glad you're doing so well on stockcharts.com. And besides your website, where would be the best place to follow your work? People that hear you now and watch this later.
Yeah, read my blogs. There's a lot of good educational content on Wyckoff. Taught Wyckoff in graduate program at GGU for 27 years with Hank Pruden. So I've tried to put a lot of those lessons into the blogs I've written. And then also I do videos, weekly videos for stock charts. And those are all Wyckoff oriented, or mostly. And then finally, you can go to WyckoffAnalytix.com, Ramon's website, and there's a lot of great Wyckoff content there.
Thank you, my trading warrior brother.
All right. Thank you. And thanks to everyone for attending.
Yeah, and thank you for edifying the F.A.C.E community once again. You're giving spirit to do it, and give us your time, Bruce. We appreciate it. So thank you very much. Thank
you, and hope to see you all again.
You will. We will. Hopefully, if we're not, glowing. Anyway, everybody. Follow Bruce and follow him on Twitter at RD Wyckoff, Bruce Fraser. Thank you again. Really appreciate it. We'll set up a time to talk to you this summer.
Terrific. Thank you, Dale.
All right, Bruce.
Take care, everyone.
All right. So that's a wrap, everyone. You could meet the team in 11 minutes on the Morning Edge. And thank you for your attention. Don't just count your X's and O's, count your blessings. And I'll see you tomorrow. Adios. You're welcome, Jane. You're welcome, Richard. Bruce is one of the best. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.